order this hearing of the Minnesota Senate Taxes Committee, Thursday, February 18th, 2026. It is 8:30 a.m. A quorum is present. I was just noting before we begin, this date is my grandmother's birthday, and she would be 132 years old. I'm kind of close to her, you see what I mean? We do want to welcome everyone back. You will notice that there's some changes that have been put in place with regard to security of this room. In particular, for members of the audience, the door that you may enter is the south door right behind us, and that is the only way you may exit. So you'll go in and out of that door. Once the committee begins, the black drape will cover looking into this room, and eventually there will be a similar pipe and drape on the other entrances. To let you know, the north door is key carded and will be put into action soon, but it is ready to receive that technology. Today, we're going to be hearing the report from the Department of Revenue on House File 1. We've had one person who requested to testify on it. Before we begin, I want to, just to make sure everyone knows that Senator Klein is no longer on the committee, and Senator Houschild, who has assured me in the future he will be wearing a tie, has become, at my request, what was I thinking? The vice chair of the committee. Also want to welcome Senator Hemmingson Yeager to the committee. She was elected last fall, and this is her first appearance as a member of a Senate committee, and in particular the Senate Taxes Committee. And we expect to learn a lot from her and her experience in the House, and that in turn we can be gracious in letting her know about Senate rules, Senate protocols, and how committees over here act. Her legislative assistant is Emily Butenhoff, and is she present? She's not present, but we hope that you will greet her as is appropriate. We have 3 pages this year. Jillian Cherney is returning for a second year as a page for this room, for G15. Paige Cox, secondly, was an intern for the Senator Westland last year. And Paige Sunny Amenti is returning this year and will be helping out in this room on occasion. So with that, we'll welcome unless you have any questions. Oh, and what's her last name? Burge. Megan Burge is joining us also as a fiscal analyst for the committee, and we welcome her. So, Commissioner. Welcome to the committee. If you'd identify yourself for the record.
Well, thank you and good morning, Madam Chair and members of the Senate Taxes Committee. I am Paul Marquardt, the Commissioner of Revenue, and Welcome to the 2026 session. I'm joined here by Dan O'Rourke and Jeremy Ness, who will introduce themselves as we go further. But what I would like to do is to just give an introduction. I'm going to turn it over to others to go over a report on H.R. 1, which is the federal bill that was signed into law on July 4th of 2025, and really contains a lot of tax items. And it's what we're talking about today are going to be items that we're kind of already linked to as far as the state, and we'll have to make those decisions whether or not we conform or not. But just to be clear that this is just talking about H.R. 1. This is not to have anything to do with potential governor's conformity bill. This is just H.R. 1 at this time. And it's a large bill. It's really an extension, a lot of things, of the Tax Cuts and Jobs Act.
Excuse me, Commissioner, do you mean by that the governor's bill might address other conformity issues beyond those in H.R. 1 that we currently don't conform to? Am I misunderstanding that?
Yeah, Madam Chair, no, I didn't mean to say that. I just said that it may or may not contain
Okay.
these items, not to say there will necessarily be new ones. But
Thank you.
it's just, that's not what we're talking about today. And so there's a lot of items in this. And in the past, sometimes you're able to pass conformity bills early. Well, filing started January 26th, so we're 3 weeks, session started 3 weeks after filing. So in some years, if let's say a conformity bill passed, I'm just going to give this an intro, that in some years it was really small items, the Department of Revenue could actually adjust your return and you wouldn't have to do anything else. But with the magnitude of the changes in H.R. 1, what the department would do is that now filers would have to amend their returns at that point. So it would not be adjusting, it would be amending. So with that introduction, I'm going to turn it over to colleagues here that will go over. And Madam Chair, I don't know how you want to handle questions. I mean,
I'll just ask the members as we go along, if that's okay with you gentlemen, and they can, if they may interrupt you.
Yes,
if they need
absolutely.
clarification. Commissioner, when did the forms go out for 2025?
Madam Chair, the 2025 tax forms are on alt right now.
They're out now.
Filing is going right now, yes.
Thank you. So if you would formally identify yourself, then we're prepared to hear your remarks.
Yes. So Madam Chair, members of the committee, my name is Jeremy Ness. I'm the Corporate Tax Policy and Technical Manager for the Minnesota Department of Revenue. I'm here today with my colleague, Dan O'Rourke. Dan will be presenting the second part of our presentation today. Today, we're going to present about why it's important to address federal tax conformity in this legislative session by going over some of the key provisions from the 2025 Federal Tax Budget and Reconciliation Bill, or as we'll refer to it as H.R. 1, enacted on July 4, 2025, and how it impacts Minnesota income taxes. These are the topics we'll be covering. We'll explain what tax conformity means and how Minnesota addresses federal tax conformity. Then we'll go over a high-level summary of the more impactful tax provisions from H.R. 1 for individuals and businesses and how they impact Minnesota tax filing. And finally, we'll discuss timing of conformity and next steps. So tax conformity is the process states use to align income tax laws with the Internal Revenue Code. Minnesota, like most states, start with the Internal Revenue Code for calculating individual and business income taxes. Federal tax conformity simplifies the process for filing state income tax returns. Most states with an income tax generally use either a rolling conformity or static day conformity method to conform to the Internal Revenue Code. Minnesota uses a static day conformity method. This means that our tax code is tied to the version of the Internal Revenue Code as amended through a particular date. Currently, Minnesota's income tax laws are tied to the IRC as amended through May 1st, 2023. Anytime a new federal tax law is enacted.
Excuse me.
Oh, sorry.
So when you say that we have to pass legislation to decouple, I thought if we don't adopt, we
Yep.
are not, we are already decoupled.
So, Madam Chair, yes. So Minnesota is a static conformity, meaning we're tied to the Internal Revenue Code as was in place in '23. We currently have not adopted any of the changes in HR 1. The process that we go through is that we update the broad Internal Revenue Code to the current version. And then if the state chooses, they do a decoupling method to
They can
maybe-
list things that they're not conforming to.
Yes.
Yes,
Correct.
thank you.
So currently, we're decoupled from everything.
Right.
All right, so unlike a rolling conformity state, which automatically updates the most current version of the Internal Revenue Code, Minnesota law has not changed and needs to pass legislation to pick up the changes in the HR 1. So Minnesota tax law relies heavily on the Internal Revenue Code. There are over 100 references to the IRC through Minnesota tax laws. Two definitions in the Internal Revenue Code are especially important to Minnesota individual and business income taxes. For individuals, federal adjusted gross income, or FAGI, is the starting point for a Minnesota individual income tax return and is calculated on the federal tax return. It includes gross income and certain above-the-line deductions, such as IRA contributions or student loan interest deduction. For C corporations, estates, and trusts, federal taxable income, or FTI, serves as a starting point for Minnesota individual or Minnesota income tax returns, and is also calculated on the federal return. These definitions are generally used as the starting point for the Minnesota income tax filing calculations. When Minnesota is not in general conformity with the IRC, the FAGI and FTI need to be calculated separately for Minnesota purposes for many taxpayers, leading to additional complexity for both taxpayers and the department. This is calculated on the Minnesota nonconformity schedules as shown here on this slide. When Minnesota is in general conformity with the IRC, it simplifies the process of completing the Minnesota tax return. The taxpayer's federal return is simply carried over to their Minnesota tax return, typically without needing to separately calculate what is considered income for Minnesota purposes. Now, Minnesota can choose to address federal update in 3 ways. First, Minnesota could choose to not conform to the IRC or a specific section of the IRC. One example of this is the Minnesota Tax Code has its own rules relating to statute of limitations and does not follow the federal dates. Second, Minnesota could choose to conform to the IRC to incorporate all newly enacted federal tax laws. This is done by updating the general IRC dates cross-referenced in Minnesota law. And lastly, Minnesota could choose to conform to the IRC and then decouple from provisions that Minnesota wants to treat differently. So we do this through Minnesota additions and subtractions from federal income and in other ways such as the corporate net operating loss deduction laws.
Mr. O'Rourke, did Minnesota ever have do a rolling conformity, or have we always been static? Do you know?
That is a good question. I don't know if we've ever done a rolling conformity. Since I've been at the department for 20 years and we've been following the static date method since then. We adopted the Internal Revenue Code of 1987. That was a big change. And as far as I know, we've been doing
That's
the static.
The ERDA bill.
Yep.
Right. Yes, Senator Weber.
Thank you, Madam Chair. It's 50 years ago next month that I joined my company. And at the time we did tax returns then, actually Minnesota was almost a separate return. You brought a lot of things over from the federal return, but I don't remember the year that we switched to bringing the adjusted gross income over as our starting point.
That's actually very recent in the
And
last 10 years.
quite frankly, we've never been easy on our tax preparers.
They make a lot of money on us.
That's right.
That's what you mean, right? Senator Driscowski.
Just a quick question while we're here. How many states are enrolling?
Madam Chair, so
Mr. O'Rourke?
there's 23 states that I count that do a rolling conformity. I believe 18 that would reference themselves as a static date. And then there's 6 or 7 states that kind of do an other thing. They call it, so there's a couple states that do both static and rolling. So they do rolling for businesses and static for individuals.
Okay, thank you. Thank you.
All right. So before we review some of the provisions in HR 1, we wanted to note the potential revenue impact if Minnesota were to conform to all of HR 1 provisions. As you can see on this slide, the cost of general conformity or updating Minnesota's IRC date without decoupling from any provision in HR 1 is $388 million for fiscal years 26 and 27, and a revenue increase of $89.8 million for fiscal years 28 and 29. The federal bill HR 1, which was previously noted, enacted on July 4th, 2025, introduces changes that Minnesota does not conform to. This affects individuals, estates, trusts, and business filing in Minnesota income tax returns. HR 1 has over 100 provisions within the tax article alone. As a result, many taxpayers must make nonconformity adjustments. These nonconformity adjustments impact the 2025 filing season. They reach far back as 2022 tax returns and will result in even more nonconformity adjustments in the 2026 tax year if conformity is not addressed this legislative session.
Commissioner, is there a general explanation about why there's such a huge revenue loss for 26, 27, and then the gain in 28, 29?
I think I'll have
Or
Mr. Ness.
Yeah.
Mr. O'Rourke?
So, Madam Chair, I'll address that. So the numbers on our presentation are taken from the November forecast, the revenue estimates put out by the Department of Research. And that breaks down the cost of each provision for 4 years. A lot of the cost, as you'll see on this chart, deal with timing issues.
Okay.
So a lot of it's upfront costs, and it varies. And some of the provisions that change don't go into effect until 26 or 27.
Thank you.
All right, let's see, where was I? All right, so the federal bill HR 1 was enacted on July 4th, 2024. Oh, sorry. So on this slide, you can see the revenue impacts of some of the more notable tax provisions from HR 1. I will be covering a summary of each one of these provisions. Today's presentation won't go over all 100 provisions, but we'll cover these on the slide. And then we also included, for your reference, a chart that covers all the provisions. It's titled "The Minnesota Tax Impacts Resulting from HR 1." And it goes through each 100 provision, the tax years impacted, the tax forms that will be impacted and when they go into effect. So first, the provision with the highest cost from the revenue estimate is the expensing rules for research and experimental or R&E expenditures. For a little background, the Tax Cuts and Jobs Act, or TCJA, changed the R&E expenditure rules by requiring domestic expenses to be capitalized and amortized over 5 years and foreign expenses over 15 years. HR 1 keeps the foreign expensing amortization at 15 years, but allows domestic research various elections. Starting in tax year 2025, taxpayers can elect to immediately deduct for domestic research expenses, or they can amortize that over 5 or 10 years. Small businesses can also elect to amend their 2022 through 2024 returns to receive the immediate deduction for the domestic research expense. And finally, all taxpayers can catch up their 2022 to 2024 domestic amounts in either the 2025 or 2026 years. All these changes contribute to the large cost shown on the revenue estimate. Current Minnesota law requires a nonconformity adjustment to change all domestic research elections back to the 5-year amortization amounts.
With regard to the 1% floor and corporation charitable contributions, is there a similar change in terms of the, which charitable contributions for individuals, the amounts relative to their AGI? And what is that? Or is it just for corporations that there's going to be that limit that brings in that kind of revenue?
Madam Chair, so I know the corporate one is specific to C corporations, and that's the 1% floor.
Yep.
Dan, do you?
Is there a similar provision dealing with charitable contributions or any kind of limits there that are beyond what we have now for Minnesota?
Yes, Madam Chair, I believe there is a similar rules enacted in this for individuals.
Is it something new,
Yeah.
new or?
Madam Chair, it's 0.5% for individuals.
Okay, thank you.
0.5% floor over
People
that.
should know that
Yeah.
as they're going to file their returns.
All right, I'll continue. So our next slide is the opportunity zones. So the Federal Opportunity Zone Program is permanently extended under HR 1 with a required redesign of the zones every 10 years. This federal program defers or excludes when funds are invested into a qualified opportunity zone. Current Minnesota law requires a nonconformity adjustment to include the deferred or excluded gain in Minnesota taxable income. This change is for tax years 2027 forward. HR 1 also permanently amended the calculation for the limitation on business interest expense, allowing some taxpayers to deduct more business interest expense each year. HR 1 changes the limitation calculation to not include a reduction for depreciation, amortization, and depletion. Unused business interest expenses have an unlimited carryover on the federal return. Current Minnesota law requires a nonconformity adjustment to recalculate the limitation for business interest expense that you can claim on each year, resulting in a Minnesota-only tracking of unused business interest expenses carryovers separate from the federal return. HR 1 adjusted Section 179 expensing by increasing the limitations within the deduction calculation. Expensing limitations increased from $1.25 million to $2.5 million, and the phase-down threshold increased from $3.13 million to $4 million. This results in more property value qualifying for Section 179 expensing. Current Minnesota law requires a nonconformity adjustment to recalculate Section 179 expensing with the lower limitations, resulting in less immediate expensing deductions in Minnesota. HR 1 broadens the exceptions to the percentage of completion method for residential construction contracts. Generally, the percentage of completion method recognizes revenue and expenses over the life of a project, while the completed contract method defers any recognition of income and expenses until the project is completed. The changes in HR 1 allow more projects to use the completed contract method, resulting in deferral of income recognition until the project is completed. Under nonconformity, taxpayers with projects within the broadened group will need to recalculate their income based on the percentage of completion method. HR 1 increases the employee-provided child care credit on the qualified child care expenditures from 25% to 40% for regular businesses and 50% for small businesses. It also increases the maximum annual credit amount from $150,000 to $500,000 for regular businesses and $600,000 for eligible small businesses. While Minnesota does not.
Excuse me, was there any change made on the child care credit for dependents for individual taxpayers? Or only, is it only an expense deduction change here for businesses that provide those services to their employees or supplement them in some way.
Madam Chair, for the record, my name's Dan O'Rourke. I'm the Individual Income Tax Policy Supervisor for the Minnesota Department of Revenue.
Thank you.
There are changes to the way it's treated for individuals, and there is some content that I have to present
Okay, we'll wait.
after Mr. Ness is complete.
Yep, we'll wait. Go ahead.
All right, well, thank you. So one last point on the employer-provided credit. While Minnesota does not have a state version of this credit, it impacts federal taxable income through disallowed business expenses and basis adjustments that impact Minnesota income taxes. HR 1 made changes to bonus depreciation by making 100% full expensing permanent. In addition, there are two other provisions that impact bonus depreciation: a new election for qualified production property and an expansion of the existing immediate expensing treatment for qualified sound recording productions. Current Minnesota law requires a nonconformity adjustment to change the allowed bonus depreciation to 40%, which has the phase down percentage for, that's the phase down percentage for tax year 2025 prior to HR 1. Also, Minnesota decouples from the full bonus depreciation by requiring an 80% addition and a subsequent 5 years subtractions. The excess business loss rules were set to expire in 2028. HR 1 makes the excess business loss rules permanent for non-corporate taxpayers. The excess business loss provision limits the amount of trade or business losses an individual can use to offset other non-business income. Once an individual's losses exceed thresholds based on their filing status, they must add the excess back to income in the current year. However, they can carry it forward as a net operating loss to be deducted in later years. HR 1 also changed the inflation adjustment, which impacts thresholds that determine when the excess business loss provisions applies. So if there is no conformity this year, next year Minnesota's law will require a nonconformity adjustment using the thresholds under the TCJA. HR 1 imposes a new 1% floor on the deduction for charitable contributions made by corporations. The 10% limit still exists as a ceiling to the deduction, which means that a corporation is allowed to claim a charitable deduction if their contributions are between 1% and 10% of their taxable income. Current Minnesota law requires a nonconformity adjustment to allow corporations a charitable deduction for contributions less than 1% of their taxable income, resulting in a Minnesota-only tracking of contribution carryovers. Another large business tax topic is the changes to foreign source income. HR 1 renames Global Intangible Low Taxed Income, or GILTI, to Net CFC Tested Income. CFC stands for Controlled Foreign Corporation. HR 1 also eliminates the Net Deemed Tangible Return Deduction, or Net DTR deduction, from the GILTI income inclusion calculation.
So we currently tax GILTI here in Minnesota. If the federal government is doing away with it, is it just in terms of the term, which is almost unpronounceable, and they don't, of course, like the fact that most people think of it as being spelled G-U-I-L-T-Y, not G-I-L-T-I. What happens if we don't make a conformity item there to our being able to collect the revenues based on our own law if GILTI itself doesn't exist?
Madam
that
Chair,
work?
to address your question. So, yes, so the net CFC tested income is the income calculation portion of what was formerly called GILTI. The net deemed tangible return deduction is part of the current GILTI calculation and is what would reduce the amount of income that a domestic shareholder would need to include in their income taxes currently. So the change to this removes that deduction. Essentially, it increases the amount of potential income inclusion. And what I was going to cover next is that net deemed tangible return deduction is based sort of a two-part calculation, which is based on the controlled foreign corporations, qualified business assets, and it gives them a 10% perceived return on investment on those assets as a deduction, and then it reduces that deduction by their interest expense that exceeds their interest incomes. So it's a multi-step calculation. The controlled foreign corporation, which is a corporation owned more than 50% by domestic shareholders, they first do their calculations, and then that is reported to the domestic shareholders. That nets out their calculation for all potential CFCs that they have an ownership in.
And so by the feds going from guilty to this NCTI, if we could just conformed on that 10% offset goes away, and that's how we get 3.9 million and 9.3 million, and I would say for free. So I'm very interested in Minnesota conforming on that, obviously. Thank you.
All right, thank you. I think we can move to the next slide, which is other foreign source income. HR 1 also makes changes to Subpart F income. Subpart F income requires U.S. shareholders of controlled foreign corporations to include specific foreign income in U.S. taxable income, even if not distributed. The first provision eliminates a 1-month deferral election for specified foreign corporations, requiring these corporations to end their tax year 1 month earlier than their majority U.S. shareholders. The second provision makes the look-through rules for Subpart F income permanent, which impacts when Subpart F income is excluded or deferred in certain circumstances. The third Subpart F provision reverses changes made to stock attribution rules enacted under the TCJA, which impacts when a corporation is treated as a CFC and as a result incurs guilty or Subpart F income. And the last Subpart F provision changes the rules on when Subpart F income and guilty is recognized as income for a shareholder of a CFC. So current Minnesota law requires a nonconformity adjustment for all 4 of these Subpart F provisions, although just to mention, Subpart F and the guilty will go into effect in tax years 2026. So they're shifting when CFCs and their shareholders recognize Subpart F and guilty for Minnesota purposes. Prior to the federal bill, Minnesota has been fully conformed to Subpart F and treats the amounts included as dividends. This means that any amount of Subpart F income included is partially offset by the corporate dividends received deduction. And then lastly on this slide, there are several foreign income changes within HR 1 that do not impact Minnesota income taxes. Minnesota is decoupled from the IRC 250 deduction for guilty and foreign derived intangible income, or FDII. In addition, Minnesota has not adopted the federal base erosion minimum tax, or BEAT, and does not provide a foreign tax credit.
So with regard to how Minnesota currently taxes guilty, we just tax it at a rate. We make no exceptions, no carve-outs. Is that typical for those states that tax guilty? Because we do hear from the business community requesting some sort of factor analysis based on the business activity within the state having an impact, as I understand it, on their guilty income. Are we typical? Do other states just say, apply a rate to your guilty income and or NCTI income as it will become, or are we a lone ranger in that?
Thank you, Madam Chair. So other states tax guilty in a variety of ways. There are a couple, or there's one in DC, I believe, that does not provide, that taxes guilty at the full amount and does not provide the dividend deduction. There are a couple states that tax it like we do, in which they treat it as a dividend and do not include apportionment. They treat it like a dividend
Apportionment,
and
yeah,
exclude
that's the
intangible
word I was
income from
looking for.
apportionment. And then there's some that tax it as a dividend, meaning they might have different dividend rates than we do. Some don't treat it as a dividend and just pick up the $250 deduction. And then a few states tax a small portion of GILTI by calling it like a 5% expense add back for the amount of GILTI. So they tax like 5% versus the 50%. So it's a variety of ways. And then some don't tax foreign source income at
Yes.
all.
Okay, thank you for that explanation. Senator Nelson.
Thank you, Madam Chair. Just a brief question. On the GILTI provisions, how many states do not tax that at all?
Mr. Ness?
So I believe there are.
Mr. Ness, you need to go through the chair
Yes,
to answer
sorry.
the question.
My-
Sorry.
My apologies, Madam Chair.
okay.
Madam Chair, I don't have exact count here on the number of states that don't tax it. We did a report last year and looked at this, and we had 46 states, and we used we used New York City because it has a large income tax, and we compared Washington DC as well, that taxes GILTI. I believe we had 25 or 26 states that did, out of the 46, that did tax it in some way. Those, maybe 4 or 5 of those are down at the bottom of like the 5%. It kind of progresses up there all the way up to the 100%. So I guess reversing that math, about around half, 4 states don't have an income tax, and then probably a little under half of the states that don't tax it at all. So under half.
Thank you. Thank
Senator
you very
Nelson?
much.
Okay. Mr. Ness?
All right. Energy credits. HR 1 modifies and terminates many of the federal energy credits and incentives. Minnesota does not have state-level equivalents to many of these federal energy tax programs. 2 of the terminated federal incentive programs make changes to a property's depreciation and will impact Minnesota income taxes. The energy efficient commercial building deduction, and also the energy efficient commercial building property deduction impacts depreciation, and also a 5-year cost recovery for energy property was terminated, requiring this property to be expensed under a longer class life. So current Minnesota law will require a nonconformity adjustment to allow the energy property to accelerate depreciation methods under these 2 incentives. The remaining 15 modified and terminated federal energy credits do not have an impact on Minnesota income taxes. All right, and then the SALT deduction. So HR 1 extended and increased the limitation on the individual deduction for state and local taxes, or SALT deduction cap. While the changes to the SALT deduction do not impact the Minnesota individual income tax return, there are impacts to the Minnesota pass-through entity tax, or PTE tax. Minnesota PTE tax was enacted during the 2021 legislative session and was directly tied to the TCJA's SALT cap limitation, which expired after the 2025 tax year. This means that Minnesota PTE tax is expired under the current law and will not be allowed for tax years beginning after December 31st, 2025. A federal update would be one way to bring back Minnesota's PTE tax. Now I'll turn over the presentation to my colleague, Dan O'Rourke.
Mr. O'Rourke, thank you very much, Mr. Neff. And if we have further questions, we'll come back to them. Mr. O'Rourke, welcome to the committee.
Thank you, Madam Chair. Good morning. My name is Dan O'Rourke, and I'm the Individual Income Tax and Withholding Policy Supervisor for the Minnesota Department of Revenue. And I'll be covering the individual income tax provisions impacting Minnesota in HR 1. First, we wanted to note the estimated revenue impacts of conforming to some of the most notable individual provisions. And again, we just wanted to include this slide so you could easily reference it after the presentation. HR 1 enhanced the Child Independent Care Credit. The credit is calculated by multiplying qualifying expenses by a credit rate, which is based on the taxpayer's adjusted gross income. and the credit rate is reduced as income increases. The previous credit range was a minimum of 20% up to a maximum of 35%. The new range is 35% up to a maximum of 50%. The same calculation is used to determine the Minnesota Child Independent Care Credit, but the Minnesota credit will be calculated using the 20 to 35% range and income limits while we're not conformed to this provision. Some employers provide dependent care assistance programs to their employees. Payments under these programs are excluded from the employee's income up to certain limits. Prior to HR 1, that was up to $5,000 of dependent care assistance from an employer could be excluded. HR 1 increased the maximum amount to $7,500. A nonconformity adjustment would require individuals to add amounts exceeding $5,000 on their Minnesota income tax return. Another provision made permanent was originally a temporary change under the CARES Act of 2020. This provision allowed employees to exclude payments from their employer for educational assistance. Employers could pay their employee or their employee's lender up to $5,250 per year.
And, excuse me, and is that above the line where it's excluded?
Correct.
Okay, thank you.
These payments were excluded from the employee's income. Also under HR 1, the annual limit is adjusted for inflation, and these employer payments would also need to be added to an employee's income while Minnesota is out of conformity. For charitable contributions, HR 1 adjusted limitations in two ways. First, it made a temporary change from the TCJA permanent, which allowed cash contributions up to 60% of adjusted gross income. The second change created a 0.5% floor for all contributions, which means all contributions are reduced by 0.5% of an individual's adjusted gross income. The moving expense deduction and exclusion was temporarily.
Excuse me, I don't understand how that works. The second one, that 0.5% floor. Give me a simple calculation of what would happen if someone had $100,000 AGI and they had $4,000 of charitable contributions.
Madam Chair, unfortunately, I don't have a great example off the top of my head to address that question.
It looks like it would be very simple, but I'm struggling to understand whether that becomes an incentive for charitable contributions or a disincentive because of a limitation. I mean, we ourselves have, in 2023, with the
Madam Chair,
progressive amount of what is not allowed for charitable contributions for those with incomes over $1 million, where they, they're limited to 20% of their charitable 20% of their itemized deductions is the limit that they can take. How would that be affected by this? Or is it simple and I'm just trying to make it complicated?
Yeah, so, Madam Chair, my understanding is that 0.5% floor, if you had income of $100,000, that 0.5% would be $500. So you could not take any deduction for that first $500, but over that,
I
then
see.
you could
That's where
deduct
the-
over
that's where
that
the limit
floor
is.
up to 60% of your AGI,
I see.
which is $60,000 at that point.
So the first cut, you have to be a generous person if you're going to take advantage of, and we conformed, take advantage of the charitable contribution as an itemized deduction. How does that affect non-itemizers? Same way?
Well, I know, Madam Chair, in Minnesota, we're one of the few states on the Minnesota side that if you take the standard deduction, you're able to take. And I think it's anything over $500, I believe, you can deduct. But not many states do that, but on the federal side, I'm not quite sure how that works out.
Well, this also would be, Madam Chair, This is also an
Mr. Rourke.
above-the-line deduction.
This, oh, it's, okay. It's still above the line, okay. All right, thank you.
Thank you, Commissioner. The moving expense deduction and exclusion was temporarily suspended for individuals other than active duty military members. HR 1 made this provision permanent. This was originally a provision from the TCJA. It was set to come back after tax year 2025. Since Minnesota has conformed to the TCJA, taxpayers will be able to claim this as a deduction or exclude employer-provided expenses from income on their Minnesota return in tax year 2026 if we remain out of conformity. HR 1 changed 2 accounts with special tax benefits. They are 529 plan accounts and the Achieving a Better Life Experience accounts, also known as ABLE accounts. For the 529 plan accounts, qualified distributions from these accounts have been expanded to include additional expenses attributable to enrollment at an elementary or secondary private or religious school. This includes tuition, books, tutoring outside of the home, and college placement exams. Qualifying education expenses also now include tuition fees, books, supplies, and equipment for enrollment in certain post-secondary credentialing programs. So these could be credentials sanctioned by the state or federal government, military credentials, certifications authorized by professional providers. For ABLE accounts, HR 1 made some changes which were temporary under the TCJA, permanent. The changes include an increased contribution limit for employed individuals with disabilities and tax-free rollovers from 529 accounts to ABLE accounts. And while we're out of conformity, taxpayers would need to include these distributions and rollovers from 529 accounts in their Minnesota income.
What are the ABLE accounts? A little bit more information about them, and what is ABLE's
Sure.
an acronym for?
Madam Chair, thank you. An ABLE account that stands for Achieving a Better Life Experience account. And these are typically with folks with individuals with some disabilities.
And do we conform on that now?
We're currently out of conformity with these
We're out
changes
of conformance
specifically.
with it. Okay, thank you.
HR 1 created a couple of new programs as well. The first is based on a new federal credit for contributions to scholarship granting organizations. To participate in this program, states must first make an election to be part of the program and then provide a list of scholarship granting organizations to the IRS. Scholarship granting organizations must use the contributions they receive to fund scholarships of eligible students within the state. Scholarships provided under the program are excluded from an individual's income. This program begins with tax years after December 31, 26. There's no conformity adjustment needed for this provision unless Minnesota decides to elect into this program. Trump accounts are a new tax-deferred account. Contributions to these accounts are made with after-tax dollars and are limited to $5,000 per year, with certain exceptions such as employer contributions, which are not included in an employee's taxable income. For children born between January 1, 25 and December 31 of 28, the U.S. government will contribute an initial $1,000 to their account. Generally, distributions cannot be made from the account until the beneficiary turns 18, and after that, they follow the same rules as a traditional IRA, which includes an additional federal tax of 10% for distributions before age 59 and a half, unless an exception applies. And exceptions include the distribution for higher education expenses or purchase of a first home. Nonconformity to this provision will require taxpayers to adjust their Minnesota income for any gain or loss in the Trump account at the time it is realized, instead of treating this as an individual retirement account, which allows taxpayers to defer the tax impacts until it is distributed. HR 1 made some changes to reporting requirements for Forms 1099 miscellaneous and 1099 NEC, as well as 1099 Ks. Previously, if a recipient received payments of $600 or more during a calendar year, the payer was required to file Form 1099 miscellaneous or 1099 NEC with the IRS and provide a copy to the recipient of the payments. The new payment threshold will increase to $2,000 for both forms of payments made in 2026. As for Form 1099K, it's used to report payments from third-party transactions such as eBay, Etsy, or Uber. The American Rescue Plan Act of 2021 reduced the threshold to submit a Form 1099K to $6,000. However, the IRS was allowed to delay implementation of that threshold and was never actually required. HR 1 reversed the reduced threshold back to the previous limit, which means that the only aggregate transactions in a year for a payee exceeding both $20,000 and 200 transactions are required to be reported. During the 2019 Minnesota legislative session, the starting point used to determine Minnesota income for individuals was moved from federal taxable income to federal adjusted gross income. And because of this change, Minnesota individual income taxpayers are not impacted by the provisions on this slide. Examples of the changes to the federal provisions include no tax on tips, no tax on overtime, and no tax on car loan interest, and the enhanced standard deduction for seniors. These deductions are added to an individual standard deduction on their federal return, but not on the Minnesota return. HR 1 made the increased standard deduction amounts from the TCJA permanent. Since Minnesota created its own standard deduction in 2019, it's been slightly different from the federal standard deduction. And going forward, these amounts are going to be a little bit larger in difference, just due to the change in the index calculations.
So the asterisk about the provisions not, that I-10 holders are not eligible for them. In Minnesota, which provisions now are accessible by I-10 holders?
Madam Chair, so none of the items on this slide would
I know, I'm
even apply to
asking for-
Minnesota tax, but
Not relative to what the feds are doing, but what we've done in Minnesota itself.
right, most notably, Madam Chair, the Minnesota Child Tax Credit and our Working Family Credit. Federally, the Earned Income Tax Credit requires that the taxpayer have a Social Security number. And that section of the Internal Revenue Code for the purposes of our child tax credit and working family credit, we look at that section of the federal tax code and say, hey, you need to qualify for this in order to qualify for the Minnesota credit, except for that one section where an SSN is required.
Thank you. Yes, sir. Senator Drazkowski.
So, Madam Chair, and I wonder, does that put us out of conformity with that provision then as well?
Mr. O'Rourke.
Madam Chair, Senator, it does not put us out of conformity with that provision. The language within the Earned Income Tax Credit section of the Internal Revenue Code, that has not been adjusted. And our state tax credit and the way that we determine eligibility was not impacted by anything in HR 1.
So, Madam Chair.
Senator Drazkowski.
So if in Minnesota, we allow people with ITINs to access that in the description or definitions of the program, and the federal government, they do not, that appears to me to be not in conformity.
Mr. O'Rourke.
Madam Chair and Senator, we are in, I guess it could be semantic, but we are in conformity with the federal Internal Revenue Code through May of 2023. And then our own laws have decoupled in this regard as far as how it treats the Earned Income Tax Credit and its eligibility. And it's just specific to that one section that says that a claimant must have a Social Security number.
Thank you, Madam Chair.
Okay. Thank you.
Slide 32. So for your reference, Madam Chair, here are the estimated costs if Minnesota were to create our own deductions for each of the items on the previous slide. Because again, these are below-the-line deductions that do not currently impact the Minnesota return. If we were to create our own deductions, these are the estimated costs that we put together.
So for the federal provision, who's responsible for verifying how much of a person's income from their job is tips and how much is their wage? Who's responsible for putting that on the tax return?
Madam Chair, that would be reported on the employee's W-2, so their employer would be reporting that. And the IRS has made some changes to the Form W-2 to include some additional information so that overtime.
What impact does that have on the employer's tax return? Any at all?
Madam Chair, I'm not aware of any impact to the employer's return. Are you aware of
So
any?
can they just pick a number out of the air and put it on there and say, here's a little bonus deduction for you?
Madam Chair, I suppose they could do that currently with, with incomes. So I don't know what the incentive would be to do that, but certainly, they are required to report accurately to both the IRS and to, when they need to the state.
But it will show up on their W-2. So if we do not conform, we would have wage income plus either overtime or tips as their, as one component of their total income for state income, that would show up on their W-2. It would be added back. So if
Madam-
they had, $100,000 and $10,000 in tips, right now, their W-2 for state income would show $110,000.
Madam Chair, the amount of tips and the amount of overtime is included in the total of the income. So for Minnesota, there wouldn't be any adjustment that would be needed. On the federal return, you would take the figures that were reported as overtime or tips and use that when completing your federal return to reduce your income by those amounts.
Okay. Senator House-Shaw.
Thanks, Madam Chair. I'm curious, for instance, at certain restaurants, I've heard that there's sort of a pooling of tips. So if you have a waitress or a waiter, the business might pool those tips and then provide it to the cooking staff or hosts or others. Do we see an impact from this law impacting that? I'm just curious, kind of similar to what the chair was talking about, how it's collected. I'm just curious how that would work, I guess. Maybe you don't know, but I'm just curious if we've thought about that.
Mr. O'Rourke?
Madam Chair and Senator, I'm not aware of any specific changes. As far as the requirements for the employer to be reporting that, I don't believe there would be any changes in how that should be reported, but it's a new program also, so I'm sure that there could be, impacts that maybe the IRS hasn't considered or is aware of.
Senator House-Shaw, it may come out in, a regulation.
Right.
Kind of advisory
Right.
of instructing businesses how they're to do that specifically, we think. I mean, they
Yeah.
could
Yeah.
do that.
I had one more question. if
Sure,
that's okay,
Senator
Madam Chair.
House-Shaw.
Thank you, Madam Chair. With regards to overtime, obviously, my understanding is that would apply to non-exempt employees because they would qualify for overtime as non-exempt employees. Do we anticipate, or does the state anticipate, a move by employers or possibly employees asking for being added to a non-exempt status? And what would your perception be on the impact that that would have from a state tax collection perspective,
Mr.
if any?
O'Rourke.
Madam Chair and Senator, that I've not considered. I don't know what the impact that would be. I would think typically we're going to be following the Fair Labor Standards Act to determine, the classification of the employee. So I would think that we would want to, generally defer to the federal government making those determinations, but I don't know what the impact would be to the state.
Okay. Continue, please.
So Minnesota has decoupled from several items from previous legislation. For casualty losses, Minnesota has permanently decoupled from the limitation to losses attributable to federally declared disasters under the TCJA ever since 2019. This limitation was set to expire after 2025, and HR 1 made this permanent while also expanding it to include state-declared disasters. Also set to expire was a TCJA provision that suspended the overall limitations on itemized deductions. This limitation was set to apply again in tax year 2026. However, HR 1 permanently repeals the previous limitation and applies a new limitation. The new limit impacts taxpayers that are at the top of the federal income tax bracket. For Minnesota purposes, Minnesota has decoupled from this limitation and enacted a Minnesota-specific limitation. And Minnesota has fully decoupled from eligible casualty losses and the overall limitation on itemized deductions in a way that doesn't require an adjustment for nonconformity for these provisions. We'd like to wrap up by emphasizing the benefit of addressing conformity this legislative session and updating the Internal Revenue Code date within Minnesota statute. HR 1 has over 100 provisions within the state, or rather within the tax article alone. And as you can see in the chart that we provided, many of these provisions impact Minnesota income taxpayers during their 2026 taxable year. A conformity bill this year will prevent more complex nonconformity calculations for Minnesota taxpayers next filing season. Also, a conformity bill this session will result in fewer taxpayers being required to amend returns to comply with statute. And the longer we are out of conformity, the more difficult it becomes for taxpayers to amend and unwind carryover impacts of Minnesota's nonconformity to HR 1. If there is a conformity bill passed, the department will need some time to analyze it and see how it impacts all tax types. To go along with this, we'll need to update our forms, instructions, and guidance for taxpayers and provide guidance to tax software providers so they can update their products. We'll also need to temporarily stop accepting returns so our systems can be updated. Implementing these changes will be easier to do this year when fewer tax years and provisions are impacting our current forms and guidance. Lastly, taxpayers need to make decisions on many of the tax provisions. And in view, the taxpayers need to decide if they want to make distributions and rollovers for 529 and ABLE accounts, opt into employer-provided dependent care assistance programs, or elect to receive advanced payments of their child tax credit. Additionally, Minnesota business taxpayers and their individual owners may also need to make estimated payments in the absence of the PTE tax. The longer we are out of conformity, the more administratively complex and impactful these decisions become. When implementing federal tax conformity, Revenue believes it's critical to minimize the impact on taxpayers, reduce complexity for both taxpayers and the department, and maintain clear guidance to support voluntary compliance. At the same time, we have to safeguard the integrity of Minnesota's tax system and carefully consider the effect on state tax revenues to ensure fairness and stability. Revenue's vision is that everyone reports, pays, and receives the right amount, no more, no less. Our partnership with you is essential in providing the information and resources Minnesota taxpayers to realize this vision. And we look forward to working with you together as we consider how to address the impacts of HR 1. Thank you.
So you made thank you very much, both of you. You made a comment about because of the likely adoption of some of these provisions. It's going to be a complicated or complex revenue estimating process. We have 90 days, and then we're adjourned, sine die. Are you up to it?
Madam Chair, we have been analyzing this bill since its
July 4th,
enactment. Yeah, and so I believe in the people of the Department of Revenue and are capable of addressing these issues.
Thank you very much. And we appreciate, I'll call on Senator Nelson in a moment. We're going to be moving on to some comments about fraud, which is a popular, the F word is a popular topic for the legislature. And I'm curious, and this is for the commissioner, are there any of the provisions that were adopted in House File 1 more susceptible to individual and/or businesses, but mostly individual taxpayers' opportunities to commit fraud against the state?
Madam
I
Chair,
mean, we have
members-
voluntary compliance, we
Yeah.
believe what people say on their tax returns for the most part. And we know of instances where people in your department have said, wait a minute, these provisions are suspect on a return.
Yeah.
But are there any new provisions in the federal one that are going to be flags for the audit departments to look at more carefully maybe than others? Just curious.
Yeah, no, Madam Chair and members of the committee, I mean, one of the main things for the Department of Revenue is, do you have something to go off of, like a filed tax return? And that's why, like, for example, any program we would do in the future would have to have, at least we would require, that it be based off of a return. Let's use an example, the frontline worker pay.
Exactly.
Their income levels were set, but the legislature, which I was part of, did not require an income tax form to be filed. We wouldn't do that today, just on what we've learned and the new actions that have been taken by the governor and the legislature. We wouldn't do that today. We would require a tax return there. So, but I can't say there's, and I don't know if either Mr. Ness or Mr. O'Rourke would have thoughts. I can't think of anything right offhand on the federal HR one.
I can't
that would
either,
have that,
but we're all going to have to, and we all have become, I think, super
Yeah.
sensitive to opportunities for scammers and fraudsters to get around our laws in order to unlawfully benefit themselves. And I think we just unfortunately have to keep asking that question almost at every point for when government is going to spend money on people, which is like in their income tax returns. We want everybody to have every single deduction that is lawful. Those folks, in my mind, are heroes. Don't pay a cent more than what you owe. But don't ask for more than what you owe. Senator Nelson.
Oh, thank you, Madam Chair. And thank you for the very thorough discussion. I really appreciate that. And the good notes as well in defining what things we need to, what things we could conform to, how much those would impact our state revenues. There's one question that I don't know if you have the answer, but I'd like to know, and maybe you are the team that would have the answer to this. According to the Joint Committee on Taxation, the largest proportional benefit of H.R. 1 would go to workers and families making less than $50,000. And I want to know, are you able to make some sort of calculation for us on as we look at what things we're going to conform to, Madam Chair. I know that we're always interested in making sure that Minnesota families are able to afford living in our state. We want them to stay here. But my question is, I just think that would be an important metric as we go forward and as we're looking at these individual conformity items. Where is that largest proportional benefit? And I think that would be important. I know I'll be asking that type of question as we debate these type of unconformity items, if that's possible. This is an aggregate amount, looking at all the conformity in HR 1. Largest proportional benefit goes to those making less than $50,000. I don't know if we can dissect that out on individual provisions that we might be including, but I think that would be an important part of the discussion.
Madam Chair.
Mr. Ness.
So I don't have those figures today. What you're describing certainly reminds me of what our tax research department puts together on the tax incident study. They may have something like that or be able to put some numbers together, so we can certainly talk to them and see, where the benefits of these provisions would lie in connection to income or for businesses. So unfortunately, I don't have your answer today.
Madam Chair.
Senator Nelson.
Thank you very much. I think that will be really helpful just as we're preparing going forward. I appreciate your work on that. Thank you.
Senator Hellstrom.
Thank you, Madam Chair, and thanks, Commissioner and others for the presentation on the bill and its impact on Minnesota. I just think it's really important. We're obviously talking about the tax side of the big, beautiful bill, which is a ridiculous name in my opinion, but I think we also have to consider sort of the holistic package of what that bill did. At the federal level, in order to afford all of the tax cuts that we just went through, they had to essentially gut rural communities like mine. They had to cut Medicaid taxes, which is going to impact the 5 critical access hospitals that I have in my district. We're already seeing the impacts of that. They had to cut SNAP benefits, the biggest proportion of which comes from rural communities like mine. We're seeing food shelf demand increase with the cost of goods and inflation in our grocery stores. And not only that, but the federal government is able to blow through deficits and spend unlimited amounts of money in order to give tax cuts to millionaires and billionaires. Meanwhile, at the state level, we have to figure out how to balance our budget and make difficult decisions like we did last year on a bipartisan basis. And so as we in Minnesota, I think, consider what conformity we might do on the big, beautiful bill, it's really important to understand that it will never come at the expense of my rural communities and our healthcare and our vulnerable populations that rely on SNAP benefits and the critical things that the federal government gutted in order to make many of these things possible for some of the wealthiest Americans in the country. In my opinion, this was the biggest wealth transfer from rural communities like mine to urban, metro, and coastal elite cities across our country, and maybe even globally for those that are over shores. It's a shame, I think, and I just think we have to have that full context as we consider these conformity issues before us here in the state of Minnesota, because I think it's a real shame what happened at the federal level with this bill, and it really makes me sad to see what it's doing to communities like mine. So I just wanted to make sure that we're clear on the full context of what this bill has done to our state and our country. Thank you, Madam Chair.
Thank you, Senator Hellstrom. Senator Dibble.
Thank you, Madam Chair. Thank you, Senator Hochschild, for your comments. I agree completely. I wouldn't say that my district is going to reap some sort of a windfall. I'd say that the vast majority of my people are going to suffer greatly by reduced access to the things they need in their lives, because you're exactly right. The way we pay for these giant tax breaks for corporations and wealthy individuals is by taking away essential health care and things like that. But even so doing, Madam Chair, it's important to note, and I'll just say very briefly, even wholesale gutting of what people need in their lives so that the rich get richer and corporations become more wealthy and more powerful, it still doesn't pay for itself. And between now and the life of the bill, another $4 trillion is added to the national deficit. So this is just a shocking bill that really, really weakens our country quite substantially. Makes a few people a little well off and more powerful and wealthy, but our country overall suffers economically, and our people suffer tremendously. So I'm glad to hear some of the details. Thank you, Madam Chair.
Thank you, Senator Dibble and Senator Hauschild. I will remind us that in 2023, the tax committee raised $2 billion in revenue to support the spending in some in the tax committee and some elsewhere. And that was all borne, all of it, every single dollar, by rich people and by multinational and wealthy corporations. We have done that. It is proven we have done that. All you have to do is look at the revenue estimates. That is not true in some of the other ways in which we raised money to support programs. So Minnesota has done that. The Democrats on this committee voted for it. $2 billion on rich people and on corporations. So we have not been slackers in imposing taxes on those who can, some of us would say, who can most afford it. One of the questions that we usually ask the question, are the rich paying their fair share? What we seldom ask is, what is the fair share of a poor person? What should they be paying in taxes? And we don't often grapple with that as we look at progressive taxation versus regressive taxation. And I think that that's an important question. And there are books, published on, with the title of the book is Who Bears the Burden? Who bears the burden of our tax policy? And we just need to have, in my mind, our eyes wide open about what that means, how the burden falls on poor people, and where in Minnesota we have placed that, at least in the tax committee in the 2023 bill, at a price of $2 billion. And maybe there are a couple of people in this room that were affected by it, but I doubt very many. I didn't pay any of it. I don't think many of you paid a dime of it. It did not fall on the poor. I don't dispute the comments about what the House File 1 did, but we should be very, very aware going forward that Minnesota took big steps in raising $2 billion from rich people and from corporations in 2023 to support those programs that are important to so many of us. We have, I'm going to call on Senator Drazkowski and Senator Weber. We do have one person, if he would raise his name, Ricky Austin, if you're here. Okay, I'll just wanted to make sure you were in the room, sir. Senator Drazkowski.
Thank you, Madam Chair. I didn't know we were going to get into ideological discussion around tax
Well,
conformity.
Hauschild started
Well, we
it.
can, by the way, Madam Chair, I understand that you and Senator Dibble and your constituents are taking the money away from Senator Hauschild and his constituents. That's what I understood from
I
his
thought we were
speech.
taking it away from you.
But the reality is I understand the big, beautiful bill that the proportional benefit is greatest for families earning less than $50,000. So, we continue to tax working people like we did in the last tax bill year, the last two tax bills that we've had before us. We continue to tax the people at work, and they continue to leave this state because they're overtaxed and overregulated and over-controlled by Democrats in this state. And at the same time, we continue to attract people who don't want to work. We're exporting our wealth and importing poverty. Now, for those of you that are bleeding heart liberals that think that this is a really, really good thing to do, at some point it's going to run out and it's not going to work anymore. And you chase all the people who are working and contributing to this huge government we have here out of this state, you and your constituents are going to have to pay this big bill that we have in front of us. So I'm just going to leave that, but we could go on if you guys want to go back and forth on ideological discussions. I look forward to that, but really, maybe we should hear from Commissioner Marquardt, Madam Chair.
And Senator Truskowski, we don't want to ignore the favorite topic of the minority for the rest of this hour about on the F word. So we're going to get to that too, and you guys will have a field day. Senator Weber.
Thank you, Madam Chair. I just wanted to make a general comment. It's always easy to, within government, to attack business. We're going to make business pay. I just want to remind everyone that business doesn't pay taxes because they raise the price of their service or their product. And that increase is borne by members of all income levels, depending upon what that product or service is. So let's remember that that costs everyone at the end of the day. And as it relates to the rich, you know, in my district, and I think in all of our districts, those individuals who have been very successful in business and have accumulated great assets, I know what the tax, there's two items that their tax preparer tells them. Number one, what are you doing still living in Minnesota? And the second one is, don't you dare die in Minnesota. And quite frankly, that has been chased many people out of our state. And I don't think it's probably possible to do, but it would be interesting to note what our income tax collections would be if we had actually worked to keep those people here rather than chase them out. Thank you.
Yeah, sure.
Madam Chair.
Senator Nelson, quickly.
Thank you, Madam Chair. Just very quickly, I didn't mean to step on Senator Weber, but I did want to just add some facts to this very important discussion that we're having around our table today. And that is, well, what if people do leave our state? How does that impact us? And I just want to give some data that I think is important as we move forward. Our state recently ranked 38th with getting just a 1% GDP, gross domestic product per capita, annual growth.
What's your source for that?
That is from the benchmarks report, the Minnesota Business Benchmarks report. We're also 40th in labor force growth. Where I live, we're having a hard time getting people to work. And I would just say that when you're 40th out of 50, that's probably not a good place to be. And the last thing I would just add, as far as some facts as we formulate these things going forward, we are 41st in the nation in net domestic migration. And that gets to the point that Senator Weber made, that people don't have to stay here. We want them to stay here. We want them to grow their businesses here. We want their families to live here. We want the workers here. So I just think we have to keep those facts in mind as we go forward in debating exact tax conformity and other things in this community, in this committee. Thank you.
Well, I'm really enjoying this, so we're letting it go on, and I really appreciate the viewpoints of everybody. But tell that to the farm workers. Senator Putnam.
Thank you, Chair West. Just very quickly, one of the things that frustrates me about taxation in general is not just paying the taxes, but it's the complexity of the tax code itself. But one of the dimensions of complexity that frequently gets left is that taxation is not an abstraction. It depends on who pays which tax, and also is immigration. And my friend Senator Truskowski and folks up here are talking about people leaving the state of Minnesota. If you actually do the math, the people who are leaving the state of Minnesota are between 18 and 24. And I work with people of that age. They're not leaving because of taxation. I know no 19-year-old who is like, oh, taxes are so high in Minnesota, I'm getting out of here. And I don't recall the exact number, but it's something like 4 times as many people from 18 to 24 are leaving the state than people who are over 50. And those people who are 18 to 24 who need to stay here, who need to work with us, Senator Nelson, are folks who come here for our colleges, and colleges cost taxation. Post-secondary education costs money. People stay here in Minnesota when you're 18 to 24 because of quality of life, and quality of life in Minnesota is better than in these other states. So we can't look at taxation merely as an abstraction or as a pure math problem. We have to think about its interactions with quality of life. And quality of life is the issue that for some young people, that's why they're leaving the state. And that's why they're not around to work in Rochester. So a little bit more precision, I think, when it comes around taxation, I think is incredibly important, but especially on this issue of us losing our population. Because again, I work with college students all the time. Not a single one of them gives one damn about how much they're paying in taxes here. And that's not why they leave the state.
Thank you, Senator Putnam. Gentlemen, thank you very much, and I'm going to ask Mr. Austin to come to the witness table. He can join the discussion, but I think he has, as I understand it, you have comments about provisions in HR 1. Is that correct, sir?
Yes.
Thank you.
Madam Chair.
Senator Dibble?
Well, while he comes to the table, if I could just maybe make a request or make an offer. Our state demographer fairly recently issued a fairly substantive report about migration out, in and out of the state. Has
It
nothing to
went
do
up.
with the things that
Yeah.
we claim around this table. There's
The
some facts that we
in-population
have.
for
So,
last year was exceeded the out-population, as I
So,
recall.
I would offer to make that report available and would
Sure.
commend it to
I
the
will-
reading
I
of the
will
members
see
of
if we
this committee, so we
can,
don't make these sweeping
At least find a
generalizations that
summary
simply are
of that.
supported.
Thank
Great.
you very
Thank
much,
you.
Senator Dibble. Mr. Austin, welcome to the committee. If you'd identify yourself for the record.
Good morning, Madam Chair and members of the committee. My name is Ricky Austin, and I serve as president of the Aim Higher Foundation. It's a nonprofit, nonpartisan organization helping 3,000 K-8 students from low-income and working-class backgrounds attend a Catholic school through our tuition assistance scholarships. I'm here today to highlight the benefits should Minnesota opt into the federal scholarship tax credit, which the gentleman before me had mentioned is an HR 1. I'm also here to talk about the positive outcomes it could help catalyze for students across all education settings in Minnesota. That includes public school, charter school, and private schools. As you know, with HR 1, Congress established this federal scholarship tax credit that provides a dollar-for-dollar credit on federal tax returns to individuals who donate to qualified scholarship granting organizations, also referred to as SGOs. To date, 27 states have opted in, and here are some of the reasons. First, this program costs the state of Minnesota nothing. It leverages federal tax policy to encourage charitable giving to any SGO, whether that SGO be connected to students attending private, charter, or public schools. Second, the tax credit does not redirect or reduce funding for public schools. In fact, at a time when state dollars are thin, this program can leverage the power of philanthropic support to help students and schools with the funds that they need to thrive. And finally, the tax credit is designed to be simple to administer while supporting working class families. To be clear, no public dollars are diverted from education funding. Instead, it encourages individual donations to nonprofit SGOs that provide support directly to eligible students. The scholarships are intentionally flexible. For some families, funds may help cover private school tuition. For other families, and in fact probably most families, the funds can be used for tutoring, transportation, academic enrichment, or services for students with disabilities. At the Aim Higher Foundation, we have received interest from a cross-section of community partners that includes teacher prep programs, museums, tutoring services, and school systems, all who use their own philanthropic funds to support educational opportunities. They've reached out because they're interested in working with their public school partners to promote this tax credit. At the Aim Higher Foundation, we see every day how scholarships and how greater access to educational options can change a child's trajectory, especially for those families who work hard every single day to navigate the challenges that put them at a disadvantage. 65% of our scholarship recipients are students of color, 61% qualify for free or reduced lunch, and 26% live at or below the federal poverty line. The average household income for a family of 4 receiving AIM Higher scholarships is approximately $38,000 a year. We are funded by private philanthropy. A federal scholarship tax credit would encourage additional charitable giving from Minnesotans, allowing organizations like ours to meet more of this demonstrated need without drawing from the state budget. To see this tax credit come alive for students in Minnesota, our state needs to opt in which the governor can do unilaterally, or legislators could write a bill to do so. However, if our state does not opt in, Minnesota taxpayers will still be eligible to claim the federal tax credit, but they would need to donate to SGOs in other states. That means charitable dollars generated here would leave Minnesota rather than support students in our own communities. To quote Sam Seaborn from the TV series The West Wing, education is the silver bullet. Education is everything, and schools should be palaces. To build the best schools and best educational opportunities, we need to keep the dollars from the federal scholarship tax credit here in Minnesota, and not let them leave to Iowa, Illinois, South Dakota, or other states. We need to give all children across all public, charter, and private schools the resources and opportunities they need to thrive. Thank you for your time and consideration.
Thank you, Mr. Austin. You made the comment that the governor could do this unilaterally?
Correct.
How so?
The Department of Treasury has set up an opt-in form, a website, where the governor can go in and opt in.
The governor by himself could opt in for the whole state of Minnesota?
Correct.
Are you sure that, never mind, I won't make that comment. Okay. We'd go after him if he did, you know that. I'll put it that way. Any comments or questions? Senator Drazkowski.
Madam Chair, do you anticipate having this provision in the conformity bill? I'm assuming you're going to be the author of the conformity bill.
No, I don't anticipate it being there, or wouldn't have my name on it.
Oh, okay. Thank you.
Okay. But it doesn't mean that that is not doesn't mean it's not a powerful argument for considering how we go about really improving the education of our children, and we should pay attention to it even when we don't agree with it.
Your intentions are not to be.
Well, because, no, I have other priorities for all of us, as you know.
So is education.
Senator Drazkowski, are you running for re-election? Did you change your mind? Thank you, sir, very much.
Thank you, Madam Chair.
Commissioner Marquardt, you're back. And I will make, Senator Dibble stepped away, but I understand that there is a committee that is receiving the demographer's report that's meeting today, and we will make that report available to the members of the tax committee the next time we meet, or as soon as we can get a hold of it. Commissioner Marquardt.
Thank you very much, Madam Chair and members. And just to finish up with the conformity, Mr. Ness and Mr. O'Rourke provided a lot of excellent information, and if you need more, just reach out. We can provide more. I also want to say is on those items like no tax on tips or overtime and that, on our website, you go under research, you can get the revenue estimate more in detail if you want to get more information on all of that. And kind of the last thing I'll mention again is that if a conformity package was to be passed and acted into law, we would at the Revenue Department ask taxpayers to amend. I mean, as of yesterday, 570,000 folks, about 18% of our potential 3.1 million filers have already filed. So it would be amendment rather than any adjustment.
That provision that Mr. Austin referred to was effective for for tax year 2025 out of HR 1? Or
I
is it-
think it's effective for 20, yeah, I believe so. I'd have to check for
So
sure
it-
on when that is, goes
So
into.
in the federal
impact.
return, it could be claimed for on their 2025 1040s, is that correct?
Madam Chair,
We'll check on
let
it.
me get back to you on
Yeah,
that.
we'll check.
And I know, Madam Chair, you also asked, even though it wasn't in our presentation, on whether or not the HR 1 changed the federal child tax credit. It did. It increased the maximum credit from $2,000 to $2,200, and also increased the amount that could be refundable up to $1,700.
And did
So it
that,
did increase it a little bit.
and did that become a permanent feature of the Internal Revenue Code, or did it have, is it sunsetted?
I believe, Madam Chair, that is permanent.
It's permanent,
I believe
just
that's
like the
permanent.
Minnesota child tax
Yes.
credit is a
Yes.
permanent one. There's no
Yes.
sunset on it.
Yeah.
Okay. Commissioner Marquardt
So-
on stopping fraud and enforcing compliance.
Very good. So, Madam Chair, and I have Madeline Hera joining me here and moving slides and so forth. And I do have other folks from Revenue. If things get really technical,
Okay.
I can ask them, and
Sure.
I'd have them introduce themselves at that time. So the Department of Revenue collects, administers, manages about $33 billion a year. And a lot of that, most of it, comes in through voluntary compliance. And so this presentation will cover what do we do to enforce voluntary compliance and what do we do to prevent and stop fraud. So that is, and take questions at any time. So usually, Madam Chair, I don't spend a lot of time on this first one, even though our mission and vision and values are important. But that second one under vision, that basically no one pays any more or any less than required by law. And I will tell you, that is a major tenet of, and the culture at the Department of Revenue is that. And that's why at the Department of Revenue, we're sticklers to making sure, as you said, everyone gets all of their credits, but, no more than what they should get, and they should also be paid their fair amount. So stopping fraud and protecting taxpayers, there's 4 main areas we're going to cover. Voluntary compliance education efforts, compliance enforcement, fraud prevention, and then when revenue stops fraud. So voluntary compliance, I always hear people say, well, me paying taxes, that's not voluntary because I have to pay those. But what the concept or principle of voluntary compliance means is that you are required by law to pay your taxes, but we rely on you, the taxpayer, to basically file an honest and accurate return. We rely on that. So the voluntary compliance and how we provide information and all the stakeholders involved in getting folks to that level is important. We estimate that we get about 97 to 98% voluntary compliance. So it's not perfect, needless to say. And we have discovery programs that for those who may not be complying, we can keep track of some other information. Look at 1099s, W-2s, all sorts of other things to make sure people are filing. But we'll move to the next one. So a real key here are the stakeholders. So it takes a lot of people to file a tax return. And there you see all of the stakeholders that is in this very important voluntary compliance there, individuals, businesses, estates. Our tax services, very important. That's why we have great relations with our tax preparers, our CPAs, our VITA sites, our software vendors, all those folks. We work with the Internal Revenue Service, of course, the U.S. Postal Service. All of these folks all come together to help with this voluntary compliance system. So a major component is let's keep things simple. If we're going to make it easier for the taxpayer to comply, let's make it as transparent, as simple as possible. Education is key. And you've probably seen a lot of efforts, there's listed there a lot of efforts that we do in getting the word out. And I'm not going to go over those, but lots of different venues and sources and ways in which we try to get that education out to our taxpayers and our stakeholders to improve. And so the next part is taxpayers. If they're going to do voluntary compliance, they expect that their very private tax information that they provide to us is going to be confidential, it's going to be private, it's going to be secured, and it's only going to be used for tax purposes. And so there's a lot of things within the Department of Revenue that's listed here to avoid what we call browsing. Browsing is someone at the Department of Revenue looking at someone's tax return where they don't have a tax reason to do that. And if that occurs, that is potential termination. It's taken very, very seriously. So we can control that a lot. A big concern this year, and just a headline just a few days ago, is the IRS sharing data with like Homeland Security. And it showed that there was a kind of a breach, that information went out that shouldn't have. That can have a real dampening effect on our voluntary compliance, because then people want to make sure, I don't want to send something into the state or the feds that's going to be used somewhere else. That's very personal information. So that is a huge goal of the department, is making sure we're protecting taxpayer information. And again, we do a lot of different ways to do that, and they're listed here, and you can look back at that. So let's look at compliance enforcement then. So again, voluntary compliance relies on security and integrity of the revenue system. Besides all of the other safeguards we've kind of mentioned, we also have a lot of our folks, especially in the divisions of income tax, corporate, sales tax, criminal investigation divisions, that go through a certified fraud examiner's training. And this is 4 days, 8 hours a day, 32 hours. There's 4 exams. And we have a huge number of employees that go through this, that kind of trains them on how to look for kind of red flags and all of those type of things. We're continually improving the process to make sure we can promote that. Another area then is collections, if we can move there. So we have a collections division, and we're going to get into the numbers, that looks at if there's mistakes made, oversights, those type of things. We can do civil enforcement. Or if there's past due taxes, or we've identified non-filers, or anyone else who might not have filed a return, we send notice, we collect. We also, let's say we can put civil penalties and interest on there. They might owe $1,000, but maybe there's now $500 in penalties. And some efforts include, which is kind of interesting, forced filing on behalf of non-filers. Chair Rest, if you didn't file your taxes, I could file those for you. And it's commissioner's filing, and what we would do is try to get as much information as we can from a W-2 or 1099 or bank account, whatever that might be, and then we would send you out a letter, of course, saying, hey, you haven't filed, and if you don't return this within 30 days, I'm going to file your taxes for you, and then, take the payment as we can. So that's kind of what's called a commissioner filing. That can occur. And then,
Commissioner?
Yeah.
Does that include, that filing include the payments that the taxpayer has indeed made, which may exceed what he or she owes? What do you do at that point?
Sure. I mean, certainly if withholding, we would, whatever that would be, I presume. Now, if there was a late filing, there could be penalties and interest attached to that. But we would calculate that as the information that we would have at that
So
point.
the penalties come not just because someone hasn't paid, which eventually they are determined to owe, but there's a distinct penalty for failing to file, separate from whether or not you have overpaid what you actually owe. Is that correct?
Madam Chair, I don't know at what point that might go to criminal or not, and I wouldn't want to say for sure, so I
Just,
yeah, I'm not quite, I don't want to
I'm
give
just curious.
I'm not quite for sure on that. Also, folks do have problems paying. They can reach out to Revenue. We can set up payment plans and work with them. I mean, some people just might not be able to pay. So we can work out things there. Here are the compliance enforcement efforts in the last 4 years, from 2022 to 2025. You can see, let's just go to 2025. $512 million came in through our collections. This is through audits, through collections, through criminal activities and so forth. And those are dollars that would not be collected but for efforts from the Department of Revenue. And so it's pretty, 77% of that 512% is from late filings, past due payments, 11, 12% are audits, another 11, 12% penalties, return corrections, and so forth. And then we also collect other agency debt, cities, counties, universities, and so forth, and that's the smaller number. But that then totals $562 million that's collected. The next one is the criminal investigation. So if things get pretty serious here, and it will go to our criminal division by 3 ways: referrals from, if we're looking within the Department of Revenue, we see something, we send it. Referrals from other federal and state agencies through tip line can go to our criminal division. We enforce all these laws, which is willful evasion or false and fraudulent returns. That's those chapters. And so at that point, we would go to criminal cases. And I think you can go to the next slide. Last year, there was 36 cases charged to the Department of Revenue. And I will say these take a lot of time to put everything together, and that's the revenues that's raised there. If you want to see where the folks are being charged, you can go to the website there, and usually, probably pretty close to every week, there's charges that reach that, where it's to a criminal case on the tax code. Okay, let's move forward here. Stop.
Commissioner,
Yes.
There's quite a bit of difference between year 22 and year 23 and 24, and then it's reduced again in year 2025. Do you have any surmises about why that happened?
Madam Chair, I do have Melanie Leslie here, who's in charge of our criminal division, if you would like her to answer that? Or, I don't know how we're going.
Yeah, we have until 10:30. I want to get through the report.
Okay.
But I am interested in that.
We will.
Maybe offline,
Sure.
that person could send us a short memo that we could distribute.
Very good, we'll do that,
If
Madam
there,
Chair.
if there is a reason, or if it just,
Yeah,
it could also be, we don't know. But if there is, it would be
no,
nice
we will
to
get
get
that
that
to you.
information.
So,
Thank you.
So we're going to go now to stopping fraud. Types of tax fraud. There you've got a number of things there. Taxpayers' misuse of taxes collected. So I'll give you one quick thing here. In 2017, we passed an anti-zapper law. And the zapper is a device like a thumb drive that for sales taxes, it will eliminate some of your sales. So when people look, it looks like the books are all reconciled and they look accurate, but they're not because the zapper's been zapping some of the sales out. Our criminal division at the Department of Revenue kind of led the charge on this nationally and convicted someone, charged them in 2018. And the software was known as Happy World. And in 2020, we actually charged the person, go all the way out to New York, the person who was making these zappers and who made the software. We went all the way out to New York to charge him, and he was also providing. So we kind of put an end to Happy World. But this is just kind of one effort where we nationally led in stopping different types of fraud. As we know, they're always trying to stay ahead of us. Next slide. Ways in which we stop fraud and protect taxpayers, fraud prevention measures. After filing, we can detect and stop fraud, and then voluntary compliance and compliance enforcement. I kind of want to get to another area. So there's tax fraud and there's program fraud. We have really dealt with tax fraud, but now with legislative actions and Governor Walz's executive actions, 2501, 2510, we're also looking more if tax fraud leads us now, we're looking at, does this lead us now to program fraud? That wasn't something that was done before. I mean, this isn't anything new, but this is new. And now with what's happened in the last year or so, we are now sharing information with other agencies. Other agencies are sharing information with us. So if they're looking at program, we also look at tax fraud. And there's a lot more concerted effort in really looking at how you embed this kind of prevention and that into the system, and that's happening now.
So when did you you started doing that or moving into that following the executive orders, or?
Yes, very much, Madam
So
Chair.
that's pretty recent, is that correct?
Yeah, Executive Order 2501 came in January of 25.
Okay, so about a year or so ago.
Yeah, we started really
You not
looking
only
at that.
looked at, quote, tax fraud, but then how it moved into discovering program fraud.
Yep, and
Thank
we've,
you.
and so that's an expansion of what we're doing. And it's just, there's a change there that's new. So here's a few other things in response to those executive orders, and you can look those through. But again, it's embedding risk management expectation into everyday work. And so those are changes that are being made. And even, you're talking about revenue, that's what we're based on and looking, but we're actually doing things different and even more scrutiny on things than we have done before. And every employee knows that expectation at the Department of Revenue, and we're working with folks. So here's a very interesting number. So in the last 4 years, we've literally stopped $270 million of fraud from going out. These are folks who got into our system by mainly falsifying their identity, IP code, whatever it is. But for the Department of Revenue, it would have gone out. So let's just look to the next one slide. Here's how that works. So someone has filed, and this is like for a property tax refund. And because their identity, they've either copied someone else's, they get into our system, but now the next step would be for it to go out. And this is where we stop it. And you can see this, we have risk indicators internally at the Department of Revenue. So it can look at things like bank accounts, IP addresses, everything like that. And does it look normal or not? And our system will put up some risk indicators. So we also analyze individually. We also have our software provider that does all of our returns, which is FAST, has something called FIVES, which is a fast identity verification system. They are also looking at their own indicators. So there's two really systems looking at, when it gets to where that stop sign is, looking at this. And if there is a certain risk score based on these two systems coming together, then it says this might be too risky to move forward. And then there's also other folks literally looking at it and auditing it. So this is, like I said, but for the actions at the Department of Revenue, $270 million in the last 4 years probably would have gone out in those areas. So other ways in which we stop fraud, forged refund checks, altered refund checks, and so forth. But if we can move that last slide, I know we're, so just in the last 4 years, and I think this is significant because, $1 of fraud is $1 too much. And as we heard before, it's taken away from programs that people really need. But through our compliance efforts and stopping fraud, which I believe, but for the actions of the department and the efforts now that the state is making, in the last 4 years, it's added up to about $2.26 billion of voluntary enforcement compliance and actually literally stopping fraud. And that comes to about $550 million per year that we're looking at. And if you put that, we collect about $33 billion. That's, about 1.5%, 2% of our revenues a year. I think it's significant. And, we're making sure that everyone pays their fair share, no more and no less. And we're just continuing to do more and more every day to catch and stop bad people who are trying to rip off the state of Minnesota every day. It's just, and I think a lot of things with Governor Walz's executive orders and things the legislature and the OLA have done is moving in really a good, strong direction to prevent and stop fraud into the future. So, Madam Chair, thank you.
Yeah, thank you very much. Are there comments or questions for the Commissioner? But, compliance enforcement and quote, stopping fraud are two separate things. And the compliance enforcement may come about from actions other than attempts to defraud us. Is that?
Madam Chair, I would agree,
It
yes.
could be mistakes, the software didn't work correctly, or, so that's one number, but it's together. Those two things is what the department has focused on in this report. Is that correct?
Madam Chair, that'd be correct.
Thank you. Any, Senator Weber, thank you.
Thank you, Madam Chair. I'm assuming then, Commissioner, that the, when those two scores come out, they indicate possible fraud, that the process for that transaction is stopped, further clarification or authentication is requested of the taxpayer at that point, or is there a full investigation initiated?
Madam Chair and Senator Weber, and again, I have folks that probably could answer that better, but sometimes there might be someone who filed a property tax return and we think it's questionable. We'll contact Senator Weber, did you file this return? They'll say, no, we didn't. And then, so a lot of that occurs. Unfortunately, because they're stealing people's identities and that, we don't necessarily know who these folks are. So a lot of it is tough to get to, but a lot of times it is a case where they've taken someone else's identity. It doesn't look right because maybe it's way more than it was the year before, just a number of things, and they'll actually contact that person. We actually had someone from the Department of Revenue actually get one of those calls, and they hadn't filed a return. But.
Sure. Okay.
Senator Dibble.
Madam Chair, I have a slightly different take on the question. It's not necessarily fraud per se, but I was reading the compliance enforcement and collections slide on number 11, and it talks about inadvertent errors, unintentional mistakes, and oversights. And I appreciate, Commissioner, that the Department of Revenue are sticklers, not 1 penny more, not 1 penny less. But I'm going to return to one of my favorite subjects, and that's when the Department of Revenue has an inadvertent error, an unintentional mistake, or an oversight, and gives the taxpayer advice that the taxpayer then takes in good faith and makes plans for, and creates their prospective tax liability, makes a lot of assumptions, particularly if they're a business, and then Department of Revenue changes its mind and decides, that activity is taxable, and you're going to have to either pay back taxes or prospectively pay on something that you weren't expecting to pay. We've talked about this before. How is the Department of Revenue? I've just sent you a letter yesterday. You maybe have seen it, where this happened to one of my substantial stakeholder groups in my district. How are we thinking about these instances when the Department of Revenue takes these steps and takes these actions that have fairly serious consequences for taxpayers and paying more taxes than they had planned, based on good faith information and their due diligence and getting bad information or seemingly bad information from the Department of Revenue?
Madam Chair and Senator Dibble, I mean,
Commissioner.
that's a great question, and there's kind of different levels of that. But, I mean, first of all, there was like the Nadler case a few years ago where a decision was made by the tax court, and we didn't agree with it, but we didn't say anything about it. And people went according to the Nadler case, and then later on, they found out we weren't accepting that way. And, you know, I think we've solved that. We now have on our website, based on legislation, other things, we now have all the court cases that occur at the tax court, and we will say then now, are we agreeing with it or not agreeing with it? So it's the transparency is huge. There's other ways, and I haven't seen your letter, Senator Dibble, yet, but I will duly see it at some point, I'm sure. But sometimes there's a misinterpretation when we go out and do sales tax audits, is that we may not audit everything, because a lot of times a business doesn't want us to audit every single area. It's just so cumbersome. And so we'll maybe make a ruling on this part of their sales tax, but not this one. And then this one we find out is non-conforming. They come back and say, well, you said it was. Well, no, we didn't say that. Yeah. But we need to be more transparent in those type of situations also. We had some proposed legislation also we're looking at, that if in fact, because this is, if in fact we said one thing and then you did that, and then we come back and we've got different attorneys or whatever later on, they're interpreting things differently. If in fact that was honest mistake, we give you one freebie, so to speak, is that we're not going to deal, but moving forward. And so, you know, we're looking, but I mean, we want to be transparent, we want to be fair. And sometimes there's more to it, the situation, than what might meet the eye, but we still have to do a better job at times also making sure we're clear with the taxpayer and that. But we will try to make things right if in fact there was something not done correctly.
Senator Dibble.
Thank you. I appreciate that response, and I look forward to more conversation on this subject, Commissioner.
Okay, thank you, Senator Dibble. Anything further? Thank you, Commissioner. It's been a very good discussions today.
Thank you,
And,
Madam Chair.
We appreciate the care and concern that you have for taxpayers and in informing and teaching us about the federal government. So we appreciate that. The committee will meet tomorrow at 8:30, and we will be hearing from the Tax Expenditure Review Commission. So with that, there being no further business, Tax Committee is adjourned.